Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you July the 25th. It is Thursday, and the year is 2019. Let's talk trading. Seeing is believing versus believing what you see. I picked this topic because I was doing some reading on forums and emails and listening to some YouTube traders and other people, comedians. And the thing is that the trading, sometimes people don't believe what they see. You see price going up, yet you believe somehow it's going down. So you have to believe what you see. I mean, if you see the price rising on the chart, price is going up. If you see the price declining or dropping on the chart, then price is going down. You don't need squiggly line indicators. You don't need to have squiggly line indicators in sub windows under the chart, over the chart, and look for divergence or look for MACD crosses or overbought, oversold conditions. You don't, all you got to do is look and see what the price is doing. It just amazes me, truly amazes me how somebody can sit there, have the screen in front of them, and not believe what they see. They obviously they don't want to believe what they see. I mean, it's just ludicrous to me. So, fellow traders, if you see what price is doing with your own two eyes, believe it. It's really that simple. Now, of course, things change, price changes. Price can be going up, going up, going up, and by the time you confirm what you see in your mind and you click, then all of a sudden price starts going down. That's just you waiting. That's just you not having faith in what you see. That's because you don't have your risk management in place. If you have your risk management in place, then you see it, you believe it, you trade it, and if it goes against you, well, you were willing to lose a certain amount on any given trade, so it hit your stop loss. Okay, it hit your stop loss. And while I'm on the subject of stop loss, I had a trader ask about stop loss placement. Now, once again, you can do it in one of two ways. But first, you have to decide your risk, how much you're willing to lose per trade. Then, if you always like to trade the same position size, then that's where your stop loss is. If you vary your position size, or if you decide to pick a place on the chart that makes sense to you where you should put a stop, then you can calculate your position size. So you hold your risk constant. So if you already know what your stop loss is here, okay, then you calculate your position size. If you know what your position size is, right, then you calculate your stop loss. That's how you determine the stop loss. I mean, it has to be based on the amount you're willing to lose. Nothing more, nothing less. So there's two variables, location of stop and position size. Simple math here. Now, let's go back to that simple chart that I showed yesterday. Remember I talked about the weekly open. You see what happened here? I mean, sometimes I have a little difficulty in pulling that cursor, but you can see here that's 57 pip run if you just took that one simple trade. Remember, I said that's a trade you can take. You can put that trade on. So in other words, price was down here. You could have put that trade on there. And you see the rest is pretty much history. And I was saying also the same thing for the daily open. You know, you come home at night or something, depending on where you are, and you see price was here and the daily opens here, you could have put that on there. Now, depending on where your stop was, you can see here, maybe if you took that trade, you might have stopped out unless you had your take profit there. But the point is, it's simple trades. You just draw a couple horizontal lines on the chart, and you're pretty much good to go. It's not difficult, traders. It really isn't. And if you're just now tuning in, the weekly gap's filled. You can see we're 109 pips off that weekly low. Here's that previous week's lower wick zone right there. You see we shot above it. You see we also hit the previous week's midpoint. Remember, I'm telling you about these midpoints. Something to be said, using these for targets, using these for entries. Buy zone, we had the pivot close to the open within the two zones, so there was no bias here. You just take what the chart shows you. Here you had a buy zone, came right through the short zone. That would have been a stop out unless you scratched that trade, seeing it just sputtered. Here, strong buy zone trade, and you should have been out somewhere here. You see here, price comes down. When that candle turned red, you should have been out, if not selling sometime in the wick zone. On the daily, we exited, broke through the previous day's low, giving up about 15 pips. Came back through, went through the lower wick zone, went through the upper wick zone. And you can see right now that if you took that high break, that was good for about 47 pips. You can see range is huge. We've got 1, 2, 3, 4, 5, 6 over 100. It's been a couple of weeks since we had that many over 100, I believe. But I guess there was some Euro news today, and it just spiked everything here on these Euro pairs. The Einstein line, you can see right here, really not much happening. You know, it's telling a story. It's just channeling right now. Just all you got to do is look at price. You don't need those squiggly lines. Let me think. I think there was another trader that asked me a question about something, but I don't recall it at the moment. If I do, once again, looking at the range of the H1 chart period, you can see here, you know, under 20 is 92% of the time. So if you're a scalper just wanting to get in and get out, there you go. Price action. Once again, price usually doesn't like to stay between these horizontal lines here on the sweet spots indicator. You can see here not much action happening. So you had 1, 2, 3 hours in a row, no movement. Here's another one, no movement. Here's another one. But usually if it starts between two lines, it's usually going to cross one line, the other, or both. But remember, fellow traders, these videos are for educational purposes only, and your results may differ from mine. So Forex trading is extremely dangerous. You could lose all your money. So seek guidance from an accredited financial professional advisor. And as you can see here, just more horizontal lines, simple stuff, just going with the candles here. See, price hit a new high, it's retracing. So the red rats will be feasting. Whoops, how'd that happen? But once again, just looking at the simple chart here, just a couple of horizontal lines, it's not difficult. It really is not difficult. Don't make trading harder than it needs to be. And you just really have to look and see what price is doing. It's not that hard. Is it going up? Is it going down? Of course, I've written indicators like this one based on if you hit the F9 key, you see here the ask, here's the bid. So if you're looking at this, if this line falls below this peak right here at 121.13.2 right here, then what's happening is I would say we're having selling because the bid got below the peak of the ask. Now, if the bid comes up and gets above this number, okay, right there, selling just started. Now, if this number here, the bid, if it gets below right here, or gets above right here, the valley of the ask, as I like to call it, then you've got buying going on. Because see, between here and here, that's the spread. So right here, said selling's going on, so you can wait and see what happens. And that's just one way. Or you can just look at the charts here. You could say almost the same thing here. Well, here was the peak and then price dropped below there. So it's time to start shorting. So the other thing is about seeing is believing. Believe what you see. Make sure you don't get fooled by randomness. And if you haven't read that book by Talib, go read that book, Fooled by Randomness. People will start to see patterns. They think they see. I love those guys who put those butterflies up there or whatever they call those things, all those triangles. It's just, if that works for you, just keep doing it. Don't listen to me. But if you're struggling, don't go for the esoteric. Don't go for this mystical stuff. Go for something simple, horizontal lines. I mean, it's just pure price action. Nothing more, nothing less, just pure price action. Simple rule of thumb, don't trade against the H1 candle color. You see here, this candle was green. If you traded against it and didn't have a stop loss, you would have had your face ripped off. Ditto for here. So just a simple rule of thumb. Just go with the flow, basically. And see, once again, people believe what they see, but the thing is, they're not really seeing. They'll start talking about different concepts like supply, demand, and support, resistance, all these things. No, what do you see? You see some rectangles and lines. That's what you see. Everything else you're interpreting. Oh, this is a candle. No, this is, that's what you call it, but it's a rectangular box right here. It's, with some green on it. It has a line sticking out. And we give these things names, but you have to be really careful because the thing is not the name. The thing is just a thing. I read somewhere, do you think a monkey cares that you call it a monkey? So anyway, fellow traders, just remember, it's not what you trade, it's how you trade it. So go out there and drain the banks. Oh yeah, and don't forget to subscribe.